Dear clients, I'm Richard, Phillip CFD dealer. Last week, the S&P 500 rose above its closing high on an intraday basis, while the Dow Jones Industrial Average established an all-time closing high, as equity market sentiment was buoyant by a welcoming stream of stronger-than-expected earnings reports. However, the Nasdaq Composite Index fluctuates at substantially lower levels than in its early April sessions, and remain in negative territory year-to-date. This performance divergence within the equity space once again underscored the ongoing sector rotation out from high-growth momentum stocks into the more stable earnings and defensive segments of recent weeks. Now, with the month of April behind us, it signifies that we have passed the halfway mark of the 1Q14 US earnings seasons. According to FactSet Tally, approximately 3/4 of S&P 500 companies have exceeded profit estimates, and most analysts expect earnings to further improve in 2Q14. I believe the equity market is riding on this earnings season's tailwind to propel itself to new highs, and allowing it to ignore recent contradicting economic data releases. However, it should be noted that the equity market celebration is approaching the point of complacency, as indicated by VIX, the fear index, currently submerged at around 13 points, a level which historically tends to ignite market concern that the positioning reversal is just round the corner. From the cross markets front, I would also like to highlight some mixed reactions that resonates a slight risk-off tone, which should serve to sober up some of the equity market's optimism. For instance, US yields tumbled 8 basis points last week and reached the lowest since February, despite an above forecast gain in April non-farm payroll numbers, and expectations that the Fed will not raise interest rates soon, citing concern that US economic growth remains uneven, has also hurt the dollar, resulting in a weekly 0.3% decline in the Bloomberg Dollar Spot Index. Gold also snapped a 4-day decline last week, with a 1.5% rise on last Friday, attributable to Ukraine uncertainty. This week, markets started on the back pedal against economic and geopolitical headwinds in the form of sluggish Chinese manufacturing data, OECD's moderation of growth expectations, and an increasingly volatile Ukraine situation with a potential May 25th trigger for possible US and EU economic sanctions against Russia. As we move further into the month of May, the US earnings season's closing curtain is drawing down upon us, and the calendar check shows that the FIFA World Cup is arriving earlier on 12th of June than the next FOMC meeting, which is on 17th to 18th of June. This could translate into a lack of near-term earnings and policy catalysts in the market, thereby leaving participants to struggle for directions and more susceptible to profit-taking pressure. Furthermore, as mentioned earlier, with equity market apparently in complacency mode, I will not dismiss the possibility as yet that an escalation of the Ukraine situation or fresh runs of disappointing economic data may just harness enough market tensions to rekindle the screening of the sell in May go-away blockbuster. Clients may consider using Phillip CFD to trade equities and indexes across markets to capitalize on trading opportunities in both rising and falling markets. In addition, you may also trade based on different strategies using many more benchmarks, which are available with Phillip ETF. Thank you for watching this week's Market Watch. I'm Richard from Phillip CFD. Tune in next week for more market video. Thank you.